You are listening to the Yield to Reason podcast, where we help you build a bulletproof retirement with a keen eye on investment income, because independent wealth hinges on your ability to pay the bills. We're dedicated to solving retirement's biggest riddle: how to turn your hard-earned savings into spendable cash so you can enjoy the retirement you actually want and make it the retirement you truly deserve. I am Brandon Roberts. Thanks so much for joining me today as we go on a deep dive building out a framework for analyzing closed-end funds for the risk of distribution cuts, which are also commonly tied to the risk of capital losses. So we buy closed-end funds primarily for the income that they can produce. And with that, we want to understand what the sustainability of the income currently generated by the fund might be. And it turns out, unsurprisingly, that the risk of capital loss is pretty tightly connected to the risk of distribution cuts, because if we buy a closed-end fund and it announces a reduction to the income that it's going to pay its shareholders, that will almost assuredly cause a decline in share value, meaning if we invested in it, especially if we invested in it recently, there's a really good chance we're going to experience an unrealized capital loss. And of course, if we sell, a realized capital loss. So we are trying to analyze what the overall risk is to changes in the income, negative changes specifically, when it comes to a fund in question. I'm going to give you 5 metrics that I personally look at when it comes to analyzing closed-end funds to try and figure out what the risk in the short and longer term might be to a distribution cut for the fund itself. To start off, we're going to talk about the big one and get that one out of the way. It's somewhat the simplest from a layperson's perspective, though I'll tell you it's not always the easiest one to parse or extract all of the data that's necessary to crunch the exact numbers and figure it out. But there's also some ways that we can kind of zoom out and proxy the overall analysis here. So number one on our list is coverage ratio. Simply put, the coverage ratio looks at the amount of net investment income the fund is generating, and it compares it to the distributions that are being paid by the fund. And what we're asking is, does the fund generate enough investment income to cover the distributions that are being paid out to shareholders? If the answer is yes, so if the fund is generating more investment income, more net investment income than it's paying in distributions, well, that means that our ratio comes out to above 100%. We're pretty happy because we are fairly confident that the fund will continue to generate this distribution for its shareholders, since it is obviously capable of generating income sufficient to pay out the current distribution. Now, when the coverage ratio drops below 100%, this isn't an immediate cause for alarm, but it does mean we want to understand why this is taking place. Now, there could totally be a reasonable explanation for a coverage ratio below 100%. I said net investment income is what we're focused on as the analysis here. That does not necessarily include, or doesn't include, the gains that are generated from certain investment activity. So the fund could be growing fund assets, not necessarily collecting income per se from those assets, but creating cash that is necessary to ultimately pay distributions to shareholders. And in that scenario, the coverage ratio would fall below 100%, but it is not immediate cause for concern. This is going to be very, very common among equity-focused closed-end funds, where there will likely be assets that are not purchased for the sake of producing income for the fund's investment income objectives, but rather create capital gains that can be paid out to shareholders. They won't be included in a coverage ratio analysis in most cases, and that will lead some people to heavy-handedly negatively review certain funds if we're not immediately aware of that. But fixed income style funds are certainly going to have fewer options or fewer opportunities to take capital gains. And that is where coverage ratio will absolutely become a more significant consideration as we analyze that style investment or that style closed-end fund. Now, if you set out to pull up a fund in question and gather data on its net investment income, you're going to discover that that's not always an easy figure to collect when it comes to something like a quote, a stock quote. So if you go to your favorite place to collect information on funds, something like a Yahoo Finance, a Fidelity, just a CNBC, plug in the ticker and get the current quote on the fund, you're not going to find net investment income all that readily available. You can get it by looking at filings that are reported by the fund. But if you don't want to dig that deep, there is another way to zoom out and use a proxy, if you will, to sort of gain insight into whether or not the closed-end fund has a positive or potentially negative coverage ratio. You want to look at how the net asset value, the NAV of the closed-end fund is performing over time. If it's increasing, then there's a wonderfully good chance the fund is doing just fine and it is growing assets at a rate that are outpacing distributions. If the NAV, on the other hand, is declining, well, that could indicate that there is absolutely a negative coverage ratio at that particular closed-end fund, and that would be a potential cause for concern. Now, I want to be clear about something when it comes to this analysis and virtually all the other ones that we're going to talk about. The presence of a negative coverage ratio all on its own at a particular moment in time is not all by itself a major red flag. The trend here is oftentimes the more important analysis. So if the coverage ratio is negative, or below 100%, how long has it been below 100%? That matters a lot. A temporary move in assets or distribution activity that causes the coverage ratio to fall below 100% may not be all that concerning and not very indicative of a high-risk distribution cut. But a negative coverage ratio that has persisted for 12, 18, 24 months, that is a much bigger problem potentially. Moving along to our next metric, let's talk about leverage, because most people who look at closed-end funds understand that they use leverage, and it is something that is certainly capable of producing additional income from closed-end funds. It's also a source of a lot of apprehension and negative sentiment as it relates to investing in closed-end funds. So trying to invest in closed-end funds and avoiding ones that use leverage is not impossible, but it's going to make your selection options extremely limited. The use of leverage all on its own is not really a source of any major concern. So the presence of leverage is not really the problem. The degree of leverage, that's what might lead to a problem. Just so you know, industry average is roughly 33% as the leverage ratio for a closed-end fund. So anything below that means that the fund is currently operating with a leverage practice that is slightly below industry average, and anything above that would indicate that the fund is making more and more use, higher than average use, of leverage. So higher leverage in general is less favorable. It doesn't necessarily mean we have a problem, but it does create a potential for reduction in distributions, because the higher use of leverage in a closed-end fund, the higher the risk of certain macroeconomic conditions shifting that make leverage more problematic. So this means it's not necessarily the case that the fund might be doing something wrong. The use of borrowed money to make the investments that create the income that closed-end funds are known for is a pretty safe practice in principle, insofar as most fund managers are using leverage in a fashion that is wildly oversimplified in this case, but I'm going to use it to try and drive basic understanding. they borrow money at a rate in general that's lower than the yield that they know they can get from the investments they're going to pursue. So there is a arbitrage-ish aspect here that says we can borrow at one level, we can invest and collect yield at another level, which is higher, and that's why we're going to use leverage. There's always going to be exceptions and some asterisks to all of that, but that's a very broad sense of how leverage is being applied to give a basic understanding. And under that basic understanding, what I want to point out here is fund managers can use this principle and by the book do absolutely nothing wrong. But macroeconomic conditions can change and suddenly cause more stress on the fund that would ultimately lead to a cut in distributions. So the issue with leverage, especially as it grows higher, is the impact that it could have on increasing the probability of a distribution cut. We don't need for a fund using very high leverage ratios a massive increase in interest rates overall in order to substantially increase the risk that the fund will need to cut distributions, if to do nothing else but bring leverage ratios back within regulatory guidelines. So if the fund that you're looking at is somewhere in the 30% range, it's pretty much on average for what closed-end funds do. And quite honestly, there's a lot of room left for certain pivoting that could be used if macroeconomic conditions turn against their favor. If they are much below that, say 20 or in the teens percentage of leverage, well, they're using a lot less than average leverage. And if their yield is looking pretty solid, they are accomplishing a very good result with very little borrowed money. That's a pretty strong indicator of sustainability. If, on the other hand, they have a more average or even above average distribution, but they're also using something like 40% leverage to do it, that doesn't mean you have to avoid it in all cases, but you must understand that the risk of that lofty income that's being generated by that much higher use of leverage may not be very sustainable, and that may result in a cut to the distribution. And in the same category of things that people tend to speak negatively about on the subject of closed-end funds, let's talk about our next metric, return of capital, as its use in the payment of distributions to shareholders. I would argue, as much as people sometimes like to talk about leverage or even the investment fees of closed-end funds, return of capital is the most misunderstood element of closed-end funds because it is very, very commonly discussed in negative terms. If a fund is paying a distribution and part of that distribution is return of capital, that's a bad thing. Now, it could be a bad thing, but it's not always necessarily a bad thing. There are scenarios that can exist where return of capital as part of the distribution is not at all concerning for the sustainability of those distributions. What we want to do with return of capital is look at it in relationship to movement in the NAV of the closed-end fund. The reason I say that, because boiling it down to a very simple two-categorization world of return of capital, we have two possible situations for a closed-end fund, the use of return of capital and what it ultimately means for the fund. On the one hand, we could have the thing everybody's afraid of, which is the eroding of the capital base. The fund is basically returning the money that it received from investors to them as a way of propping up the distribution. So they're giving you whatever they managed to create from investment gains, but then also some of your money back, which may be okay in some situations, but that's not the ideal circumstance for people when it comes to investing in closed-end funds for the most part. Alternatively, we have the use of capital or the return of capital, but the fund is making that capital larger. And what I mean by that is they're investing in things that are growing in value. So the return of capital on its face is not eroding the capital base or eroding the overall value of the assets in totality held by the fund. So here's how we do this analysis. It's unbelievably simple. If the fund is using return of capital and the net asset value of the fund is growing, we really don't have any kind of concern taking place. If the fund is using return of capital as a component of paying distributions and NAV is declining, that is a much more concerning circumstance. Now, I should have mentioned this earlier, and I didn't. Apologies for that. I'm going to mention it now. When I say NAV, I mean NAV. I do not mean share price. So it's easy to confuse those two things because closed-end funds will report NAV, but most of us pay attention to the share price because closed-end funds trade on the open market. I don't care about what's happening to share price in this case. I care about what's happening to NAV over time in relationship to up, down, or sideways if the fund is using a return of capital as part of its distributions. Now, if the return of capital, when we look at it as a component of distributions, is less than 30%, and we have a NAV that is stable or increasing, again, not a lot of reason for concern here, because in that situation, the fund is growing assets at a pace larger than the distributions, even though it's returning some of the capital to its shareholders. If we've got return of capital as far as the distributions and it's comprising more like up to 50%, but the NAV is still kind of holding steady. It's not declining, maybe not increasing very much. Again, we know we're not experiencing capital erosion inside the fund. Now, if we have return of capital, kind of any percentage, and a declining NAV, now we have more reasons to be concerned. Lower percentage return of capital with a declining NAV, it's not necessarily clear that that's the cause for the declining NAV, so it's not an immediate red flag. But if we start seeing return of capital inch up to something more in the range of like 40% of the overall distribution that gets paid out, and we have a declining NAV, it's almost certainly the case that declining NAV is in part and probably large part to the fact that the fund is eating through capital in order to pay the distribution to shareholders, and that is not a good thing. Now, this one can be a little tricky to capture as things are unfolding because return of capital may start to become part of the distributions, but changes in NAV may take a little time to catch up with that practice. So you may want to look at NAV over more like a 1-year period to try and figure out what the overall trend is, and distributions at a similar or possibly lagged by a quarter in order to figure out, all right, is this practice actually creating a reduction in the net asset value of the fund? So again, return of capital existence as part of the distribution all on its own is not necessarily a problem. It's a problem when it's taking place and NAV is declining. That's when we get much more concerned about return of capital as a component to distributions. Next up, undistributed net investment income. Fantastically good metric to look at. Obnoxiously difficult metric to gather, especially if you don't like looking at financial disclosures, or you don't happen to pay for some of the more sophisticated stock analyzers, stock analyzing tools that are out there. So this one is a disclosed piece of information, and some of the more sophisticated analyzers will give you access to this information. But if you are pulling up your information through free sources, you're going to have to roll up your sleeves and get comfortable with reading financial disclosures, which are almost always available on the fund company websites, by the way. So in fact, they're always available, not almost always. They are always available on the fund company websites. But it will take a lot more picking through to get to this number, or to get to the data that gives you this analysis. So the idea here is this is essentially a cash reserve. It's a collection of money that will allow the fund to pay the distribution that it's currently paying for a certain period of time because it's holding on to the cash to do it. Some funds, not all of them, for sure, hold on to a year's worth of cash for paying distributions. much more common to see something more like 6 months. So anything greater than 6 months would be a very good indicator that the risk of a distribution cut it's quite low. Now, if this buffer is under 6 months, well, now the probability of a cut is substantially higher. There again, this is one of those things where we could look at movement in NAV and get a relative sense of whether or not the fund really is holding on to cash that allows it to pay the current distribution for a while. One other thing on this. So funds that have a managed distribution policy commonly have a pretty good position here on undistributed net investment income. So they usually make the announcement for multi-period distributions. And what I mean by that is, let's say that it's a fund that pays monthly and they pay 10 cents per share per month. And you now know that they've already announced the distribution for January, February, and March. That is pretty indicative of holding on to a cash position that would allow them to cover those 3 months without any incident. Now, one thing to call your attention to as you're analyzing various funds in different sectors. So closed-end funds that are engaged in writing covered calls will almost always have a negative undistributed net investment income. That has to do with the way accounting for options premium works. And so if you're looking at covered call closed-end funds, and you look up this data or this metric and see that we've got negative undistributed net investment income, that is not cause for concern. If you were doing it with a fixed income fund and it's negative, that is cause for concern potentially, because what that indicates is the fund has no cash on hand to cover next month's, or the next 3 months, or the next 6 months distributions. So it needs the investment income that it hopes to generate to materialize in order to pay the distribution. And if it doesn't, it's either going to have to turn to return of capital or announce a distribution cut. Our last metric to go over for analysis is NAV performance relative to distributions. Again, seemingly simple, but does involve a certain degree of nuance because we have to apply rules specifically to funds in different sectors with different exposures because we can't always analyze them identically. Very, very simplified. This is looking at the performance of the accounting of the assets held by the fund up against the payment of distributions. So, simply put, if a fund has, let's say, a current yield of 6%, and its 1 year growth in net asset value is 10%, that's a very, very good sign because we're seeing that the fund is growing assets at a pace in excess of the income it's distributing to shareholders. Now, if we flip these numbers, so NAV is growing at 6%, but distributions are 10%, we have a potential problem on our hands. I'm not saying we have an absolute problem on our hands. I'm just saying we have a potential problem on our hands because distributions are at a higher rate than the growth of assets inside the fund. And the sustainability of this becomes a little more questionable. Now, this is a much more sensitive metric for fixed income closed-end funds, which happens to be the majority of closed-end funds. The reason for that, those funds are much more dependent on the net investment income that they generate, and they're less likely to have capital gains opportunities, as I mentioned earlier. There's a little bit of an exception for that when it comes to high-yield bonds, since those do have a tendency to bounce around a bit in terms of price and could potentially create capital gains opportunities. But in general, a fixed income style fund is going to have much more sensitivity with regard to NAV growth and distributions if they are substantially out of line. So again, I said 6%, let's say, as the NAV growth, as our flipped example, and 10% distribution, that starts to cause some concern for how the fund is going to maintain positive growth, paying out that distribution, and not have to dip into capital to continue paying that distribution. But if we're talking about an equity-focused closed-end fund, the rules are less strict, because there are going to be a lot more opportunities to potentially take advantage of a capital gain. Now, in general, that capital gain should show up in NAV appreciation, because if the holdings of the fund are in fact appreciating, then we should be able to see that as the reconciliation of net asset value for the fund is done. We should see a corresponding increase in NAV that would tell us that, okay, NAV is increasing. But sometimes the timing doesn't always work out perfectly. And there may be certain assets that the fund is holding on to that haven't had their day yet. So the appreciation event may not have taken place. And we may see distributions that almost seem like the fund is being a little reckless. It's paying out a little more than it's supposed to. And that might cause us to prematurely harshly judge the fund for having a distribution policy that is outpacing the growth of NAV. The best way to try and smooth out these issues is to extend the time frame under which we are trying to make this analysis. So 6 months is not going to be as solid as 1 year, which is not going to be as solid as 2 years and 3 years and so on. So the longer the period of time we look at, what's the growth of NAV over the last 3 years, for example, and what's the distribution policy like over that 3-year period? That gives us a better indication of how well the fund is matching distributions to overall growth in net asset value. Now, typically speaking, you're not going to see return on NAV outpacing distribution by a super wide margin. In fact, my example earlier of 10% growth of NAV and 6% yield, that's probably kind of an extreme example that's unlikely to exist among most closed-end funds. It's going to be something more like, if 6% is the yield, probably 8%. On the higher end is going to be growth in NAV being, hey, we got a good thing going. The reason being, most funds are not going to sit on that much extra cash. They're going to pay it out. But you could very, very likely see distributions substantially higher than growth of NAV. There are closed-end funds for sure that exist right now that probably have something like a 15% distribution, so 15% yield on shares, but their NAV growth could be sitting somewhere in the like 5% range. So there's a pretty good spread between what the distribution rate is and what they're actually growing assets at. And that becomes a lot more questionable in terms of sustainability of those distributions as they get paid to shareholders. Now, in many respects, you do want to try and take these 5 metrics to analyze and put them together and come up with an overall opinion on a particular closed-end fund you're considering buying or trying to make a decision on whether or not you should keep one that you have. They're really, I want to be careful about suggesting that there's any sort of red flag or deal breaker as far as these analyses go. So, for example, if you've got return of capital at like 50% of distributions and a 3% decline in NAV over the last year, that's not a good thing. But that doesn't automatically mean a cut is imminent. So you do want to look at some other aspects of the fund and get a sense of any sort of redeeming figure that you could take a look at. And I'll note that you may already realize that a lot of these analyses or metrics, they kind of tie together in the sense that we can use change in NAV as a sort of baseline in a lot of cases across several of these metrics. That's done by design because there are multiple segments of analyses for closed-end funds that are going to be tied to each other because they're all ultimately looking at the health of the fund, kind of expressed through its ability to generate income relative to its ability to generate either investment income for the fund or gains in the assets that it holds and invests. And that ultimately is what will drive its ability to turn around and pay shareholders. That's everything for today. Thanks so much for joining us. We'll be back next week. In the meantime, you can check out more content on YouTube. And until then, please remember, real wealth doesn't just add up, it writes checks.